Welcome back to No Nonsense, where we drop the act and give you all the facts, powered by NerdWallet. My name is Steven Smith, and today we're going to be discussing FHA loans versus conventional loans. There's a misconception that needs to be dispelled. Most home buyers believe one of two things. Either FHAs are only for people with bad credit and no money, or conventional is for grown-ups, and that's supposed to be what you graduate to once you're financially responsible. And honestly, that belief might be costing you tens of thousands of dollars. So in today's video, I'm gonna break that myth completely, because in 2026, choosing the wrong loan program doesn't just affect your interest rate, it affects your monthly payment, your approval odds, and how much house you can realistically afford. So if you're planning on buying a home or just thinking about it, you need to understand how FHA loans and conventional loans work in the real world. And before we dive in, if this is your first time here, please subscribe to the channel. We break down real world money decisions about mortgages, credit, wealth building, without the fluff or the scare tactics. This video is for educational purposes only. I am not a financial advisor, and I recommend that you always talk to a qualified mortgage professional before making any big financial housing decisions. Now, with that said, let's jump on the NerdWallet site. I have my computer in front of me, and we're going to start with FHA loans and what you need to know in 2026. Now, these are mortgages that are backed by the Federal Housing Administration, and their core mission is simple: to make home ownership easier and more accessible for people, and that's what we're going to discuss right now. The link will be in the description in case you want to read this article, but we're going to discuss a lot of these nerdy takeaways. Now, FHA loans were created for buyers who don't have flawless credit or a huge pile of money for a down payment or a perfectly polished financial past. And let's start with some of the requirements, okay? FHA loans are technically allowed for credit scores as low as a 580 for a 3.5% down payment, but in the real world, most lenders like to set their own rules, so you actually may have a different minimum. It can always be higher. So some of you might be asking yourself right now, what happens if my credit score isn't at a 580? Well, if it falls between a 500 and 579, you can still qualify, but you'll need to bring a 10% down payment to the table. And even with those caveats, FHA loans are still much more forgiving than conventional loans when it comes to your credit score. Once again, all of this is going to be in the article right here if you want to read it. So scrolling down to the next section that we're looking at, it's going to be debt to income ratio. Now, they also allow for higher debt to income ratios, and in many cases, you can still qualify for an FHA loan with a DTI of about 43%, even with a score between 500 and 579, as long as you meet other requirements. Now, another important section that I want to cover is right here. So with a score of 580 or higher and strong compensating factors, some lenders even approve DTIs up to 50%. And that is a big deal for buyers, especially with student loans, car payments, or life expenses that, of course, have not magically disappeared yet. Now, one of the biggest myths that I hear constantly is that FHA loans are only for first-time home buyers, and that simply is not true. FHA and conventional loans are available to repeat buyers as long as they meet the necessary requirements, even buyers with multiple properties. Another misconception is that FHA loans are automatically worse. In reality, because FHA loans are backed by the government, they often come with lower interest rates than conventional loans, especially for borrowers with moderate to low credit scores. And like I said before, that difference alone can save you hundreds of thousands of dollars per month, depending on the loan amount. Which brings us to the next section, the disadvantages of FHA loans. Because yes, FHA loans, they do have their downsides. I'm going to talk you through this, but dismissing FHA loans entirely is still one of the biggest mistakes that a buyer can make. Now let's start with this first section right here. This is where FHA loans start to feel a little less friendly, and that's mortgage insurance. They're mandatory with FHA loans, and it sticks around for a very long time. So I want to scroll back up to this section so we can get a little bit more details, but you'll pay an upfront mortgage insurance premium, usually about 1.75% of the loan amount, and that's going to be at closing costs. Now, most people roll this into the loan, which means you're paying interest on it over time, and on top of that, you'll pay monthly mortgage insurance. And this part right here is definitely big. You want to pay attention to this. If you put down less than 10%, that mortgage insurance will last for the life of the loan, not 5 years, not until you feel like you've earned it, for the entire loan, unless you refinance or you sell. And if you put down 10% or more, your mortgage insurance will last 11 years, which is of course still not short, but at least it does have that expiration date. Now, this is the trade-off for FHA's flexibility. Lower credit standards, higher DTIs, they will come with higher long-term cost. Now, the next section that I want to cover is going to be for FHA appraisal. So FHA loans also come with stricter property standards. So when you make an offer using an FHA loan, the home must pass an FHA appraisal. And this isn't just about value, it's about safety and habitability. They're going to be checking things like handrails, peeling paint, exposed wiring, whether this home is safe, it's sound, it's secure, nothing outrageous, but enough that some sellers hesitate to accept FHA offers, especially in competitive markets. This doesn't mean FHA buyers can't win, it just means there's extra hoops to jump through. If this breakdown is helping you make sense of mortgages without your eyes glazing over, then please make sure that you subscribe to the channel. We break down credit, loans, and money in plain English so you don't have to decode lender jargon on your own. Now, switching gears, we're going to be taking a look at conventional loan requirements for 2026. So let's scroll down here and let's take a look at the conventional loan credit score requirements. Now, to qualify for a fixed rate conventional loan, you will typically need a credit score of 620 at least. But if you have a credit score of 740 or higher, that's where things get really comfortable. Debt to income ratios are typically capped at around 36%, though some lenders will allow flexibility with strong credit and income. The biggest advantage here is mortgage insurance flexibility. Private mortgage insurance, or PMI, on conventional loans usually cost around 0.46% to 1.50% of the total loan amount per year. The exact rate you pay depends mainly on two factors: your loan to value, or the LTV ratio, how much you're borrowing compared to the home's value, and your credit score. Better credit and a larger down payment usually means cheaper PMI. Now, I'm switching over to a different article, and that's going to be the FHA versus conventional loans. And I want to scroll down because I want to show you that comparison between the insurances. And that's going to be right here. Okay, perfect. Now, with the conventional loan, private mortgage insurance goes away once you reach 20% equity. Now, you can get there by paying down the loan, you're benefiting from appreciation, or requesting a new appraisal if your home's value has increased. And once you hit 22% equity, lenders are legally required to remove PMI automatically. Now, that alone makes conventional loans very appealing for long-term affordability. Now let's talk about property standards. We're going to scroll down a little bit right here. Okay, now that's what I want for conventional loans. Unlike FHA loans, the appraisal is primarily concerned with what the home is worth at the time in the open market. The lender's main goal is to protect their money. So if you stop making payments and the home ends up in foreclosure, they need confidence that selling that property will cover the remaining loan balance, and that protection disappears if the home was valued too high at purchase. The physical condition of the home, on the other hand, is typically reviewed through a separate home inspection. While an inspection isn't always mandatory, hiring a qualified inspector can reveal expensive repairs or safety issues that aren't obvious at first glance, and that information could influence your decision to move forward or renegotiate. And another key difference when it comes to flexibility is that conventional loans aren't limited to primary residences, so you can also use them to purchase second homes or investment properties. FHA loans are restricted to owner-occupied primary residences. So right here we have our summary of FHA versus conventional loans. So which one is better? Well, there is no universal better option between an FHA and conventional loan. It really depends on where you stand financially. These two types of loans are built for different types of borrowers, and the right choice comes down to your credit profile, your cash position, and your overall debt to income ratio. If your credit score is less than perfect, your debt to income ratio runs a little high, or you plan to rely on gifted funds for your down payment, then an FHA loan can be more forgiving when it comes to home ownership. On the other hand, if you have solid credit, stable income, enough cash for a larger down payment, then a conventional loan may work in your favor. Cost-wise, whether an FHA loan ends up being more expensive than a conventional loan depends on the loan amount and how much you put down. Which brings us here to a mortgage calculator, and this one's a mortgage amortization calculator, but you can kind of figure out exactly how much you're going to pay in interest when it comes to FHA and conventional, and that's the easiest way. You want to compare this by running the numbers. A standard mortgage calculator can estimate your monthly payment for a conventional loan, while an FHA specific calculator will factor in the upfront and ongoing FHA mortgage insurance requirements. And then one more thing I want to bring up here about these loan limits. Both loans will have some type of cap on how much you can borrow, and these limits change based on your location, and also they change annually. So for 2026, FHA loan limits range around $540,000 to well over $1.2 million depending on the market. Just be sure to check the current limits of your specific area so you know exactly where your price range falls. Conventional loans follow the same conforming loan limits set by the Federal Housing Finance Agency. In 2026, the standard conforming limit is in the low 800,000 range in most parts of the US. Any mortgage that exceeds that amount is considered a jumbo loan, and when it comes to that, it's tighter underwriting rules and higher qualification standards. So in short, guys, FHA loans tend to favor flexibility and accessibility, while conventional loans tend to reward stronger financials. The best choice is the one that aligns with your numbers today and your long-term plans tomorrow. If FHA is the only way that you can buy right now, it may be worth it if conventional puts you in a better long-term position. Waiting could make sense. The worst decision is choosing based on myths instead of math. If you want help reviewing your options, then talk to a qualified lender. And if you want more breakdowns like this that actually make sense, make sure that you subscribe to the channel. New videos like this will be coming out all the time. I want to thank you so much for watching, and I will see you in the next one.